Welcome to Min Chao, where law, finance, and real estate complexities are made clear, actionable, and empowering. The information provided on this channel is for entertainment and educational purposes only and does not constitute legal, financial, or real estate advice. For advice tailored to your specific situation, please consult with a qualified professional. If you'd like to consult with us, please book an appointment through our website. Investing involves risk, and you could lose some or all of your investment. Past performance is not indicative of future results, so whether you're looking to protect your assets, grow your wealth, or make intelligent real estate moves, you've come to the right place. Chapter 4. 3 Fancy Options. Strategies for next-level beginners. You're betting that the market will go down significantly. When others panic, you profit. You're not a villain, just a well-prepared realist with excellent timing and a lack of empathy. In this chapter, we explore the long put, debit spread, and leaps, 3 powerful option strategies for traders who dare to bet on disaster, master their bullishness, and commit with resilience, much like enduring relationships on reality TV. Long put, profiting from doom and gloom responsibly. Imagine purchasing a car and saying, "I hope it explodes so I can finally make money." That's the essence of long put energy. The long put is your go-to strategy when you're feeling a little suspicious about a stock's future. Maybe it's giving off bad earnings report vibes, or perhaps you just have that financial sixth sense tingling. Whatever it is, a long put lets you profit when things go south. In straightforward language, buying a put option gives you the right to sell a stock at a predetermined strike price before a specified expiration date. Long put payoff chart. Imagine you suspect SnugMug Inc., that oddly named tech darling, is about to nosedive harder than a cat trying to jump onto a slippery countertop. So, instead of just shouting, "I told you so," into the wind, you buy a long put option. This gives you the right to sell the stock at a specific price, let's say $50, regardless of how far it crashes. You pay a $5 premium for this right. Think of it like buying disaster insurance, except instead of saving your house, you're hoping SnugMug sets itself on fire so you can profit from the ashes. If the stock price tumbles to, say, $30, you can still sell it for $50. That's a $20 gain, $50 minus $30, minus the $5 premium you paid, leaving you with $15 in pure glorious "I was right" money. If the stock doesn't drop below your break-even point of $45, strike price $50 minus premium $5, you won't make a profit. If the stock stays above $50, your graph is at negative $5, representing your maximum loss. But once the stock starts to fall below $50, your payoff line rises like a roller coaster in reverse. The lower the stock goes, the more you make, all the way down to the $0 zone. For once in life, going down is a good thing. A long put is the pessimist's power tool. You pay a little upfront and cross your fingers for a market meltdown. If SnugMug stumbles and takes a nosedive, you'll be laughing your way to the bank, reveling in your clever foresight. But if it soars instead, well, you've only invested $5 in a bold prediction and a captivating tale to share. All in all, that's not a bad deal at all. Debit spread, the fancy sandwich of options. A debit spread, more specifically, a bull call, debit spread, is when you buy a call option and sell another call option on the same stock with an identical expiration date but at a greater strike price. It's like inviting two guests to the party, one who's optimistic and willing to pay full price, and the other who shows up to bring the snacks and offset your costs. It's a little more advanced than the classic buy and hold, or even the long put, but still friendly enough for first-time spreaders. The option you sell brings in some cash, helping to offset the cost of the one you bought. This means less money out of pocket, lower risk, and a defined maximum loss. Debit Spread Payoff Chart. Above is the payoff chart for a debit spread, an effective option strategy that reflects a balanced approach to investing. I'm bullish, but not attempting to win the lottery. I want a small win without any drama. The debit spread is designed for individuals who enjoy some excitement in their investments but prefer not to risk significant losses. Think of it as investing with training wheels. It's innovative, efficient, and allows you to express, I am bullish, but responsibly. The SnugMug Setup. You're mildly optimistic about SnugMug Inc., a fictional company that probably makes overpriced AI-powered coffee mugs. You're not expecting a moonshot, just a decent climb. You buy a call option at $50, which costs you $3. This gives you the right to purchase the stock at $50, even if it rises to $100. However, since you also want to manage your expenses, you sell a call option at $55, which brings in $1. This reduces your total cost for entering the strategy to a net debit of just $2. That's the maximum amount you can lose. Why is that? Because you aren't shorting anything, you're not using margin, and everything is defined up front. Debit spread, break-even point. When you purchase a call option with a strike price of $50 for $3 and sell a different call option at $55 for $1, your overall cost is reduced to $2. This positions your break-even point at $50 plus $2 equaling $52. If the stock reaches exactly $52 at expiration, you find yourself at a pivotal moment, standing strong with no profit or loss, ready to embrace the next opportunity that lies ahead. Long call, option, break-even point. Your break-even point for the long call option is calculated by adding the premium you paid to the strike price. If you purchase a call option with a $50 strike price and pay a $3 premium, your break-even point would be $53. This means the stock price needs to rise to at least $53 by the expiration date for you to start making a profit. If it ends at exactly $53, you break even. You recover your $3 but make no extra profit. Sold call option break-even point. The break-even point for the sold call option is $56. As the seller, you keep the $1 premium as long as the stock price remains at or below $55. You only begin to forfeit that premium once the stock price rises above $55. At $56, the $1 profit you earn from selling the call is offset by your obligation to sell the stock at $55, which is why this price is considered the break-even point. Debit spread options, key numbers. When SnugMug sinks to $30, the art of losing gracefully with a debit spread. If SnugMug tanks to $30 by expiration, your bullish dreams are crushed like a forgotten banana in a school backpack. Your long call at $50 is entirely worthless. It's like holding a coupon for a $50 massage when the spa has burned down. That's $3 gone down the drain. Your short call at $55 is in the money because who's going to buy SnugMug for $55 when it's limping along at $30? You keep the $1 premium from selling it, which is a small consolation in a sea of disappointment. When the financial dust settles, your total debit spread loss amounts to the $2 net that you paid to enter the trade. In the world of debit spreads, when the stock doesn't move in your favor, your risk is capped. And so is your heartbreak. It's like ordering a spicy curry and only mildly regretting it later. SnugMug at $50, where hopes flatline and premiums ghost. If SnugMug Inc. reaches exactly $50 on expiration day, then your $50 call option is at the strike price, but not a penny in the money. That means it's worthless at expiration. No one wants the right to buy the stock at $50 when it's trading at $50. So your long call expires with zero value and the $3 you paid for it is gone. Meanwhile, your $55 call, the one you sold, is also in the money. You get to keep the $1 premium you collected from selling it, which helps ease the sting of the $3 you spent on the long call. But let's do the math. You spent $3 and only recovered $1. So your total loss is $2. That's the worst case scenario for this debit spread. And it happens when the stock finishes at or below the lower strike price. It's like preparing for a party, paying for snacks, and then nobody shows up. Not a disaster, just a quiet little loss, and a reminder that defined risk trades are great at keeping the drama low, even when things don't go your way. SnugMug at $51, $1 in the money. Imagine SnugMug Inc. ends up at $51 on expiration day. You're feeling cautiously optimistic, like finding a leftover slice of cake in the fridge, but it's one day past its best before date. Let's break this down. You bought the $50 call option for $3. Now that the stock is at $51, this call is technically in the money. However, don't celebrate just yet. You only have the right to buy at $50 and sell at $51, which gives you exactly $1 of intrinsic value. Since you paid $3 for the option, you're still down $2 on this leg. It's like spending $3 on a scratch ticket that only wins you a single dollar. Not quite enough to quit your job. Regarding the $55 call you sold, it is in the money because SnugMug didn't reach the $55 mark. Therefore, you get to keep the $1 premium. Think of it as a small rebate for participating in this options rodeo. You experienced a $2 loss on the long call, but earned $1 from the short call. This leads to an overall loss of $1 on the spread. SnugMug at $53, a modest victory lap. SnugMug's stock closed between $50 and $55, finishing at $53. While it may not have brought the excitement you hoped for, it's not a total disappointment either. Think of it as going to a birthday party, expecting cake, and finding muffins instead. Your long call at $50 is finally worth something. At expiration, it's $3 in the money because you have the right to buy SnugMug at $50 while it's trading at $53. That's like having a VIP coupon for front row seats that works. But don't get too excited. You paid $3 for that call, so your gain is entirely offset by the price you paid. In other words, you break even on this leg. On the other hand, your short call at $55 is still safely in the money. Nobody is going to exercise the right to buy SnugMug at $55 when the market price is only $53. So it expires worthless, allowing you to keep the $1 premium you collected initially. It's like someone paying you to not show up to their garage sale. Odd, but profitable. Let's discuss the bull call Debit Spread. In this strategy, you invested a net of $2, $3 for the long call, minus the $1 received from selling the short call. When the stock price reaches $53, your $50 long call is valued at $3 but is offset by a $3 premium, resulting in no profit from that position. Meanwhile, your $55 short call remains worthless. In this scenario, you can still realize a total profit of $1 from the premium of the short call. While it may not be a fortune, it's certainly enough to warrant a little happy dance in your living room. So, when SnugMug lands above $52, but below $55, your debit spread is in profit territory. It's the options equivalent of finding a $2 bill in your laundry. Unexpected, small, but quite satisfying. SnugMug hits $80, your debit spread goes full Rockstar. SnugMug Inc. doesn't just meet expectations, it soars beyond them, reaching an exhilarating $80 on expiration day. This isn't merely a success, it's a moment to celebrate. If you are holding a bull called Debit Spread, buying a $50 call and selling a $55 call, this is your time to shine. Let's begin with the $50 long call you purchased for $3. With SnugMug now at $80, your right to buy the stock at $50 is valued at a remarkable $30. After subtracting your initial cost of $3, you achieve a profit of $27. Consider your $55 short call, which you sold for $1. It may have felt like just a casual move, but now it carries weight. With the stock at $80, the buyer of that call will cash in, leaving you responsible for the $25 difference between $55 and $80. Since you only received $1 in premium, you face a $24 loss on this leg. You made $27 on your long call. You lost $24 on your short call. This results in a maximum profit of $3 for the spread, calculated from the difference between $27 and $24. Even though the stock price is partying at $80, your profit is capped at $3 because you limited your upside when you sold that $55 call. This is why debit spreads are beloved by cautious optimists. You know your worst case and best case scenarios from day one. No surprises, just a pleasant, well-managed ride up the stock chart. Leaps, slow-cooked profit potential, buying. A leaps call is like proposing to your crush on the first date for a wedding in 2 years. You're hopeful, committed, and probably ignoring all the red flags, while weekly options may melt away like ice cream on a hot day. Leaps, long-term equity. Anticipation securities age gracefully, like fine wine or that can of beans sitting in your pantry. With their extended time frame, leaps come with premium price tags. They're like the slow cooker of option strategies, low maintenance, long-term, and surprisingly satisfying. Leaps call option payoff chart. You've bought a Leaps call option on a fictional company we'll call SnugMug Inc. You pay $10 for the option to purchase the stock at $50. That $10 is your premium, a fancy way of saying you paid someone else to take the risk while you dream of riches. The strike price is $50, and unless the stock price surpasses that hurdle, your dream may remain just that, a dream. Green line. Strike price, $50. This dashed green line is your starting line. Think of it like the diving board. Below $50, your option is just a very expensive napkin. No gains, just losses. Red line, break-even point, $60. The dashed red line is where the magic begins. If SnugMug's stock price is above $60 at expiration, you start making real money. Below $60, you're still in ouch territory. Blue line, Leaps call payoff. This blue line is your emotional roller coaster. It's flat at minus $10 from $0 to $50, meaning if the stock price ends up anywhere in that zone, your option expires worthless and your wallet feels lighter by $10. But once the stock price goes above $50, the line starts heading up. You're gaining $1 for every $1 the stock goes above $50. But remember that you paid $10 to play. So real profits don't kick in until $60. Leaps put option payoff chart. This graph looks like a caffeinated squirrel could have drawn it, but reveals the calm, calculated soul of long-term bearish strategy. This charming purple line represents your profit and loss across different stock prices at expiration. A Leaps put option gives you the right but not the moral obligation to sell a stock at a fixed price, called the strike price, sometime in the distant future, often over a year away. In this case, the strike price is a cool $50, which you can see heroically marked with a vertical green line. This is your line in the sand. If the stock stays above it, you'll miss your potential profit. You pay $10 for this Leaps put. That's your premium, your upfront cost, your Netflix subscription to pessimism. If the stock ends up at exactly $50 when the option expires, you lose all $10. Because why would anyone want the right to sell at $50 when the stock is already trading at $50? It's like having a coupon for a product that's already full price. Technically valuable, practically useless. The break-even point is at $40. Every dollar the stock drops below $40, that's pure profit. If the stock nosedives to $20, you're sitting on a $20 gain minus the $10 premium, resulting in a net gain of $10. Not bad for someone who bet on the company struggling to keep its act together. The chart's flat line above $50 shows your maximum loss, the $10 premium. Because Leaps have long expiration dates, the dreaded time decay doesn't gnaw at your position as quickly as with short-term options. You know you're a Leaps trader if you've forgotten what you bought. Leaps puts are like planting a pessimistic seed and patiently waiting for a company's stock to wilt. In summary, Leaps options are like ordering a slow cooker meal in the microwave age. They take time, test your patience, but when the conditions are just right, they can be deliciously profitable. Regular options cater to traders who embrace speed, stress, and short-term strategies. Leaps attract patient optimists and long-term thinkers, those who envision themselves as the next Warren Buffett, but with leverage. There you have it. Thank you for watching Min Chao's channel. where law, finance, and real estate come together for an enjoyable experience. Please like, comment, and subscribe for more tips and laughs. We look forward to seeing you in the following video.